It's time for a brief market and economic update now that we're a little more than halfway through 2015. Some topics I'll touch on include the market volatility, Greece, and China's stock market rally and decline. There have been some interesting surprises, as there often are, but let's get to some numbers. Overall, it's been a relatively lackluster year for most investors so far in 2015. U.S. stocks, measured by the most widely followed S&P 500 index, are up just 1.2%. Surprisingly, more risky small U.S. stocks have gained more than 4%. Here's a number, $27 trillion. That's the value of all U.S. stocks. Of course, a well-diversified portfolio is more than just U.S. stocks. Did you know that the total value of all U.S. stocks only accounts for about 30% of the value of all stocks in the world? I often wonder why so many investors have such small portions of their money in international stocks. Anyway, European stocks, in spite of the concerns about Greece, have gained nearly 5%, far outpacing the gains in the U.S. The stocks of emerging countries such as China, Korea, Taiwan, and others gained about 2.5%, but this is not telling the whole story that I'll touch on soon. Another headline grabber has been the price of oil. It's fallen about 15% in 2015, but this is relatively minor compared to its collapse in the second half of last year. And how about the investment stud Warren Buffett? For the last 35 years, his stock has done phenomenally better than virtually any other investment, compounding annually at more than 20% per year. For the first half of 2015, though, it's down more than 9%. This is a very simple reminder that great long-term returns often require some patience during various markets. And lastly, even the most conservative investors owning U.S. government bonds have actually lost a little bit of money in 2015. All that being said, regardless of whether or not you're a conservative or aggressive investor or somewhere in between, gains, if there are any so far in 2015, have likely been very small. Let's take a pop quiz. The topic is volatility. Volatility is simply the fluctuation of prices up and down. Here's the question. How much lower than average has volatility been in 2015? The answer, 24%. That's right. So far this year, volatility has been 24% below its 2.5-decade average. This is contrary to the gut reaction of most investors. I think this is partly because investors hear that the Dow Jones has fallen 100 points, and it sounds like a lot. It used to be, but today a 100-point drop is only about a 0.5% move, and 0.5% changes in stock prices happen all the time. Let's get outside of our borders and talk about Greece and China. Both have been getting a lot of attention. Greece has serious economic problems because the Greek government can no longer pay all of its bills. In particular, it cannot make its debt payments to other countries. The direct impact of this on your portfolio is, worst case scenario, minimal and likely nothing. The vast majority of international stock funds do not have direct exposure to Greek stocks. That is the case for the international stocks in all of our clients' portfolios. The indirect impact of Greece, though, is much more difficult to measure and really is all just speculation. It's generally believed that Europe is at the greatest risk of a Greek default, creating some sort of domino effect, but to date, as we saw earlier, European stocks are higher year to date. Second, what's the significance of this number? China's stock market is the second largest in the world with a total value of about $14 trillion, or about half the size of the U.S. stock market. The fact is, it's big, and it has a much higher likelihood of having some impact on your investments. Take a look at its performance in 2015. The Chinese market surged more than 25% and then gave it all back by early July. These are really big moves for such a large market. This wild performance is being driven by three things: speculation by Chinese individual investors, lots of borrowed money, and China's government policies. Here's one last number that indicates how much speculation is taking place in China: 82%. That's the number of individual investors in China who trade their stocks at least once a month. It's the highest in the world. Clearly, everybody in China has wanted in on the stock market action. So the final question is, who cares? The direct impact of China's stock market on your portfolio is likely real, but still not terribly significant. We recommend investors have a fairly large percent of their portfolio in international stocks, much more than a typical investor. We do this because the long-term better returns that it delivers. Even our most aggressive investors have less than 3% of their total portfolio in Chinese stocks, so the wild ups and downs have little overall direct impact. Chinese stocks are just one of the many types of investments in our clients' super diversified portfolios. It's the indirect impact that could be meaningful simply due to the size of the Chinese stock market and economy, but today it's only speculation as to what kind of indirect impact the world might feel. That's my summary for the first half of the year. What it looks like for the second half, I have no idea. Likely more surprises that people are not predicting today. That's of course why they call them surprises. If your portfolio is invested today consistent with your long-term investment goals, stay the course. If you need advice on what you should be doing, or you'd like to learn about how our super diversification investment strategy helps weather through some of the ups and downs of the market, let me know. I'm happy to help you in any way I can. Thanks a lot for your time.